And I think what drives a lot of the story and a lot of the narrative of the headlines that we're seeing today about investors being upside down and things start that the future crash of a lot of investors. And first off, I want to say that a lot of those headlines are not driven at investors, they're driven at speculators. They're driven at speculators who bought pre-built units with never with the intention of actually buying and owning that unit. They were going to assign those units. They stepped up, they wrote a check, they got into the down payment mode. They now have an obligation to that unit. And guess what? They're not going to be able to close on those deals for any number of reasons. So when you're only hearing those headlines or reading those headlines, it sounds like, there's no possible way to invest in Toronto. And to your point, it's not true.
I'm going to say something controversial, Patrick. The people that are doing that deserve to lose money.
Yeah. I don't think it's a case of deserve. I think
they sure as hell, they deserve whatever's coming to them. If they're not going to be strategic and sophisticated investor and do the work you and I do before we invest, they deserve whatever else coming to them. And that means losing money. That means losing money, because I've lost lots of money on shit I didn't do my due diligence on. And that's because I didn't do the work. So if they're not willing to do the work, they deserve what's coming.
Well, and they're protesting the bank for raising rates. So, anyways, it's all.
Now I'm being the pragmatist, and you're being the optimist. We've done a role reversal here. I'm a little concerned about this show already. Okay, let's move on, because I talked about putting more than 20% down, maybe putting 25% down or 30% down, and a lot of investors watching this are saying, yeah, well, JG, nice for you to say maybe you can do that. By the way, I couldn't always do that. Sometimes I had to go raise money in order to do that, raise capital, find partners. I had to get creative around how to do that. That takes us to the conversation about OPM, Patrick. OPM, other people's money. I hate that term because I just find it's got a negative context to it. I don't like it. But the point is, this has been in the news a lot lately because not everyone and how you protect yourself if you're going to invest in real estate is very important.
Something is, OPM, other people's money, is it feels to me, it always sounds a little, there's a disrespectful connotation behind it. As in, it's not my money. I don't have to worry about it. I don't know. That's just my story around it. I definitely, you like the capital partner or joint venture partner, that kind of a thought process, which respects the money that's coming in. Now, here's the thing about other people's money. And, that whole concept, and what drove that was people that, once again, speculators that were buying into, supposed experts. And this is so critical in today, given what's going on in YouTube and Facebook. I mean, everybody's a real estate investor expert, and they're guiding people. They're saying, come with me, I'll show you how to get ridiculous returns. And, if something's too good to be true, it's the old adage, of course, if something's too good to be true, it usually is. Now, the other side of that OPM article was the fact that many of these investors were actually only written promissory notes for the money that they had put up. Now, for those who are a little bit more sophisticated, understanding that a promissory note really isn't worth a lot when it comes to the court and, having to defend something and or try and get your money back. The promissory note really isn't worth the paper it's written on, although it seems to be an agreement. Guess what? Even if you have a promissory note, what's the obligation of the person that you lent that money to or partnered with? So these are challenges. And if you're not doing your diligence, if you're not understanding joint ventures and agreements and what being a capital partner really represents or means, you can get caught. And this is exactly what's happened. And it turns out the investors, and this was really built around what was happening in Saskatchewan, they were doing some crazy stuff down there.
Yeah. I mean, like you said, Patrick, there's ways to protect yourself, whether that's, putting a caveat on the property, as we call it here, caveat. There's other terms in other provinces. Yep. Are you registering a second mortgage against this property? I mean, there's a variety of ways to protect yourself, but investors have to protect themselves. It's very, very important.
But let's talk about something. Let's shine a light on one fundamental thing. And this goes back to even what I started with and what you actually said, back in 2015, you were putting 30% down. Well, you weren't looking at what was happening in the next 6 months or even the next year. When we look at real estate investing and we start to understand what is the time frame we're looking at, that's where people get caught in the emotion of the hype that's happening in this particular environment, in this particular period in time, and they don't look into the future and say, well, what is an exit strategy going to look like in a year, 5 years, 10 years. What is the strategy and what's your exit? And a lot of those investors that got caught were caught in the hype of and the promise of great returns in a short period of time. And that's where you get caught.